Another cash management procedure that we go through every month is a bank reconciliation. A bank reconciliation is to keep in line what is the difference between what is in our cash account in our accounting records and what is our cash account in the bank statement. So we have this variety of bank services. We deposit money at banks, we have bank accounts, we pay out of those bank accounts with checks, we get a bank statement. We can also do electronic funds transfers to pay bills or pay suppliers, or to usually we use electronic funds transfers for payroll payments. Signature cards are cards that are kept at the bank that show who has the rights to draw money from accounts, to deposit money into accounts, or take money out of accounts. A deposit ticket is used to deposit money in the bank. It lists everything that we're putting into the bank along with the total amount. This serves as a proof of deposit. If we would have checks, we would list the checks separately and have the name of the check or who was on the check. This kind of proof of deposit is required for businesses as a internal control. A check is used to withdraw money from the bank. We would have information about what the company name is, who we are paying, how much we're paying them, what the bank is. We might have information about we have that we're paying $375. We have the date. We have a check number up in the corner, what it's for. We're paying for store lighting design. We might even have, if there was an invoice, we could put an invoice number on there, an account number in the memo. And then we have a bank statement. So once a month, the bank sends us a statement showing us the activity in the account. What was our previous balance? What were our total deposits? What checks did we write on the account? And what was our current balance? So we have various information here. We have deposits, that's money we put in the bank. EFT, as we can see, is an electronic funds transfer. CM is a credit memo, so that can be money that the bank collects on our behalf for a notes receivable. We have interest earned on this account. It's an interest-bearing account. So DM, we have a debit memo. So that's where we pay a note payable either to the bank or someone else. Another electronic funds transfer. And NSF is a non-sufficient fund check. So what normally happens for NSF checks is our customer paid us with a check and then their check didn't clear because they didn't have enough money in their account. Sometimes there are associated fees that we pay for that. When we get this bank statement, we want to check the current bank balance against our accounting records and see if that's the same amount of cash that we have in our accounting records. It rarely is, mostly because of timing differences. It takes time for even electronic transfers to clear a bank. So on the date of receipt, we can have things that the bank doesn't show as cleared yet. So when we're preparing a bank reconciliation, we want to explain the difference reported on the bank statement and the cash balance currently in our company's books. So we're going to make adjustments to the bank balance by adding any deposits that haven't cleared yet, subtracting outstanding checks, and adding or subtracting corrections or bank errors. For our book balance, we're going to add any interest earned and any unrecorded cash receipts. So we can remember on the last slide where we earned $8 in interest. That wouldn't have been recorded in our accounting books yet. We're going to subtract any bank fees that we have and our non-sufficient funds checks. And then we're going to deal with any corrections of book errors that we need to do. Book errors can occur if we recorded something incorrectly. Say instead of $65, we wrote it down as $56. That happened. So the balance of our checking account rarely equals the balance in our accounting records, and that is because of timing differences. It also is because of bank fees collected, any interest that we might have earned. So we have deposits in transit, we can have outstanding checks. And so once we've done the bank reconciliation, we then record journal entries or adjusting entries to bring our accounting records up to what the cash balance is. So like we would need to record that we had earned interest that the bank had given us to add that to the cash account in our accounting records. This is an example of a bank reconciliation. So we can see that our bank balance says that we have $2,050, but our book balance says that we had $1,405. We have that they collected a note on our behalf, we had interest, then we also have outstanding checks, we ordered checks, so we had a bank fee, and we had a non-sufficient check. Once we finish the bank reconciliation, our adjusted bank balance and our adjusted book balance should equal or reconcile with each other. We then are going to look at what happens when we do our adjusting entries. So we need to record that we received cash for a note receivable. We also need to record that interest revenue. We're going to record bank fees as miscellaneous expenses or bank fees. And then we have that non-sufficient funds check. So we see here that that non-sufficient funds check was received as payment for an accounts receivable. Well, it didn't clear, so that payment never was processed. So we need to put that accounts receivable for that customer back on our books and reduce the amount of cash that we had recorded as receipt. The last thing that we look at in Chapter 6 is the days sales uncollected ratio and use it to assess liquidity of our company. So if you remember in Chapter 4, when we looked at inventory and days inventory and sales. So now what we're going to be looking at is how long does it take us on average to collect accounts receivable payments from our customers. So how we figure that out is we divide our amount in accounts receivable by our net sales and take that figure times 365 days. So how much time is likely to pass before we receive cash from our customers who buy things on credit? So we can see here Starbucks and Jack in the Box. So we have comparisons. Starbucks has a 14.2 day average collection. So on average, it takes 14.2 days for our customers to pay their accounts receivable debt. When we look at this and we want to do an analysis of these companies, we have 3 years information. One of the things that we want to look for when we're assessing the liquidity of a company is whether or not that number is going up or down. If it is going up, that means it is taking them longer to receive cash from their customers. If we see a negative trend like that, they can start to have cash flow issues because they're not receiving cash from customers as fast as they were. So we can see here that Jack in the Box has increased from an average of 11 days to 16 days. It takes 5 extra days to collect cash on their accounts receivable than it did 2 years ago. That could cause cash flow issues for Jack in the Box because that means that their customers aren't paying as fast as they were. We might have to dig into that further and say, okay, did they have a discount of some kind, like a 2, 10, and 30? And did they change that to a 2, 15, and 30? That would certainly change the number of days in which their customers were incentivized to pay them. That is the end of chapter 6.